Imagine you've worked for 40 years. You've saved diligently. You've invested consistently. You've finally reached retirement with $1 million nest egg. Then, just a few months after your retirement party, the stock market falls 30%. Have you failed? Not necessarily. In fact, another retiree could experience the exact same average investment returns over the next 30 years and end up with hundreds of thousands of dollars more than you. How is that possible? It's because of something called sequence of returns risk, one of the biggest threats to a successful retirement that many people have never heard of. Today, I'll explain what sequence of returns risk is, why it matters so much during the first few years of retirement, and most importantly, what you can do to protect yourself if the market crashes. Most people believe retirement success depends on earning a good average investment return. That sounds logical. If your portfolio averages 8% per year over the next 30 years, you should be in great shape, right? Not exactly. And then, once you begin withdrawing money from your investments, the order in which those returns occur becomes just as important as the average return itself. That's sequence of returns risk. Think of it this way. If you're still working and contributing to your retirement account, a market downturn can actually work in your favor because you're buying investments at lower prices. But retirement changes everything. Instead of adding money to your portfolio, you're taking money out. And withdrawing money while your investments are losing value creates a dangerous combination. Let's use an example. Roberto and Susana both retire at age 65. Each has a $1 million portfolio. Each withdraws $40,000 during their first year of retirement. Both experience exactly the same average annual return over the next 25 years. Here's the difference. Roberto experiences a bear market immediately after retiring. His portfolio drops significantly during his first 3 years. Susana enjoys strong investment returns during her first decade, before eventually experiencing a market decline later in retirement. Same starting balance, same withdrawal amount, same average return, different outcome. Why? Because Roberto had to sell investments after they had fallen in value, just to generate retirement income. Those shares were permanently gone. Even when the market eventually recovered, Roberto owned fewer shares to participate in that recovery. Susana, on the other hand, experienced years of growth before the downturn arrived. Her portfolio had already increased substantially, making later market declines much easier to absorb. That's sequence of returns, risk in action. Financial planners often refer to the first 5 to 10 years of retirement as the danger zone. Not because markets always decline, but because if they do, the impact can be severe. Let's say your portfolio falls 25%. At the same time, you're withdrawing money every month to pay your mortgage, buy groceries, travel, and enjoy retirement. You're forced to sell investments at depressed prices. That's called selling into a down market. Eventually, markets recover. Historically, they always have. But if you've already sold a significant portion of your investments, those assets are no longer available to rebound. That's why two retirees with identical average returns can have dramatically different retirement outcomes. Now here's the encouraging part. Sequence of returns, risk isn't something you eliminate. It's something you prepare for. And there are several strategies that can significantly reduce its impact. Let's talk about them. Strategy number 1, build a cash reserve. One of the simplest ways to reduce sequence risk is keeping a cash reserve. Instead of selling investments during a bear market, you can temporarily use cash to cover your living expenses. Think of your cash reserve as shock absorbers. When markets become volatile, your retirement income doesn't have to. Many financial planners recommend keeping somewhere between 1 and 3 years of planned withdrawals in cash or other highly liquid, low-risk assets. The goal isn't to maximize returns. The goal is to avoid selling investments after they've fallen. Strategy number 2. Be flexible with spending. Not every retirement expense is fixed. Housing, utilities, insurance, those usually have to be paid. But vacations, home remodeling projects, new vehicles, or luxury purchases, those can often wait. During a difficult market, temporarily reducing discretionary spending can allow your investments more time to recover. Even modest spending adjustments during bear markets can have a meaningful long-term impact. Flexibility is one of the most valuable retirement assets you can have. Strategy number 3, diversify your income sources. Many retirees rely on multiple income streams: Social Security, pension income, part-time work, rental income, required minimum distributions, and investment withdrawals. The more diversified your income sources, the less pressure there may be to sell investments during unfavorable market conditions. This doesn't eliminate market risk, but it can reduce the amount you need to withdraw from your portfolio during downturns. Strategy number 4, review your withdrawal strategy. Many retirees simply withdraw the same inflation-adjusted amount every year, regardless of what's happening in the market. In some situations, that's perfectly reasonable. In others, it may increase sequence risk. Some retirees use more flexible withdrawal strategies, reducing withdrawals after years of poor market performance and increasing spending after stronger years. The important point is that your withdrawal plan should adapt to changing circumstances, rather than running on autopilot. Strategy number 5, keep the right investment allocation. One common reaction after a market crash is panic. People move everything into cash because they don't want to lose any more money. Unfortunately, that decision can lock in losses and cause investors to miss the recovery. History has repeatedly shown that some of the market's strongest days often occur shortly after some of its worst days. Missing those recovery periods can dramatically reduce long-term returns. That's why your investment allocation should reflect your ability to tolerate market declines before they happen, not during them. No one knows when the next market crash will occur. Not me, not television commentators, not economists, not even professional money managers. The goal isn't predicting crashes. The goal is preparing for them. Every retirement plan should assume that multiple bear markets will occur during retirement, because historically, they always have. If you're retired for 25 or 30 years, market downturns aren't unusual. They're expected. The retirees who tend to do best aren't the ones who predict the market perfectly. They're the ones who build a plan that can survive uncertainty. Sequence of returns. Risk sounds complicated, but the idea is actually simple. When you're saving for retirement, market downturns can become opportunities. When you're spending from your retirement savings, the timing of those downturns matters. That's why retirement isn't just about building wealth. It's about managing withdrawals wisely, having enough cash for difficult periods, remaining flexible, avoiding emotional decisions, and remembering to isor. Successful retirement planning isn't about predicting what the market will do next. It's about preparing for whatever the market decides to do. If today's video helped you better understand sequence of returns, risk, I'd appreciate it if you'd click the like button and subscribe to Keep More Retire. Each week I share practical strategies to help you reduce taxes, make smarter retirement decisions, and keep more of the money you've worked so hard to save. Thanks for watching, and I'll see you in the next video.